The change in the SALT tax deduction and those limits is arguably the biggest change in the new tax laws. How's it work? How's it going to impact your planning this year? I've got that and more coming up. My name's Mike Bernard. I'm the host of the Wise Money Show. I'm also one of the certified financial planners right here at Korhorn Financial Group. Make sure you hit that subscribe button, turn on notifications, and smash that thumbs up button. The U.S. tax code is the most complicated tax code on the entire planet, and that's not anything to brag about. It's extremely complicated, made up of rules, and then exceptions to those rules, and then exceptions to those exceptions, and so on. And yet, we've got another new tax law that we're all trying to digest on top of the tax laws from just a couple of years ago that were changed. On top of that, all the stimulus tax laws, there were tons of those that changed a whole bunch of stuff. And before that, the Secure Act. So within the past 5 years, we've had enough changes in the tax code to choke a horse. And we're all trying to figure out, all right, what are all of these new rules and how does it impact your tax planning? Well, arguably the biggest tax law change within the most recent tax law changes has to do with the SALT, state and local income tax limit changes. Okay, so actually this change is actually giving some relief to taxpayers. So how does it work? And then how does it impact your planning right now? To start, let's just do a flyover of the standard deduction versus the itemized deduction. When you do your taxes every single year, you add up all of your income from all your different sources and you subtract out a few specific deductions. Things like a pre-tax 401k contribution, HSA contribution, health savings account, IRA contributions, those sorts of things. All of those deductions are considered above the line deductions. They come right off of your income, okay? So you add up all your income and then subtract out some specific above the line deductions. That gets you to something called your adjusted gross income, or AGI. Once you get there, you then go, it's sort of choose your own adventure. You get one of two paths. You can get a standard deduction, or you can itemize your deductions. You can add up certain categories of expenses or deductions, and you get the higher of the two. Back in the Tax Cut and Jobs Act, the standard deduction was doubled effectively, and it's now this year for 2025 was supposed to be $30,000 for married filing jointly. With the new tax laws, it got a little bit of a boost, so it's $31,500. So that's the standard deduction, married filing jointly. So you're either going to get that standard deduction, or you can go through and add up certain specific itemized expenses. And if that itemized math, right, that itemized list equals a higher number than that standard deduction, then you're going to itemize. You're going to get your itemized deductions. What is that list of itemized deductions? You can see here a 2024 Schedule A. That's the technical schedule that it's called in your tax forms. The first category of expenses is medical and dental expenses, so you add up all of your out-of-pocket medical expenses, but the only ones that get to come over to the right side of the screen and be part of your of this math of this deduction is whatever amount equals above 7.5% of your adjusted gross income. So the higher your adjusted gross income, the higher the threshold, the hurdle that you need to get over before these start to benefit you. So there's already sort of a threshold there. The second category is the taxes you pay, and that's been dubbed the state and local tax or SALT tax deduction. You add up your state and local taxes, your property taxes, your excise taxes, and all of that adds up. Well, starting in 2017 with the Tax Cut and Jobs Act, this was limited. There was a cap at $10,000 applied here. I'm going to come back to that. Next is the interest that you pay on your mortgage. You even get to include some points that you pay. Gifts to charity, charitable deductions. Now, by the way, the new tax laws are changing this slightly. There's going to be a new floor of 0.5% of your adjusted gross income, making things very, very complicated. But charitable contributions there. And then theft and casualty losses doesn't apply to a lot of people. I hope it doesn't apply to you. Work with the CPA if you think you've got an issue there. And then some other itemized deductions. By the way, miscellaneous itemized deductions, that used to be a thing back before the Tax Cut and Jobs Act. That's still no longer a thing. So this is the list. You get to add up all of these expenses, and if this list equals a larger amount than the standard deduction, then you're going to claim that larger amount, that itemized. If this list is a smaller amount than that standard deduction, you'll get the standard deduction. Now, to the big change, the state and local tax, that limit, that part of that that itemized deduction, it was limited to $10,000. And that ruffled a lot of feathers if you pay a lot of state and local taxes, either because you have a high income or you live in a high tax state or high local state. Or local tax area, or you pay a lot of property taxes, either because you've got a large value house or you live in an area of the country that has high property taxes. This was a meaningful cap. You typically would get a $20,000, $30,000, $40,000 deduction here, and it was limited to $10,000. Well, in the new tax law starting this year, 2025, that limit has been raised from $10,000 to $40,000 unless you're married filing separately, and then it's limited to $20,000. So that's a huge relief. However, there are a few gotchas, okay? You've got to be aware of a few new limitations with this. One is there's a income phase out. If your adjusted gross income exceeds $500,000 for all individuals except for married filing separately, then you start losing some of this $40,000 cap. It starts shrinking back down. And if your income, adjusted gross income, exceeds $600,000, then it goes all the way back to that $10,000 limit that we started at, okay? So that $40,000 limit only applies to those whose income is below a certain threshold. And again, going back to where this SALT limit impacted people the most is if you paid a lot of state taxes because you had high income, or you pay a lot of property taxes, which also can coincide with high income. But this kind of this sort of gotcha is if your income is too high, then you're going to be limited on receiving this extra deduction. And then the other gotcha is it's not permanent. Yes, this new SALT cap, this new SALT limit of $40,000 starts this tax year, 2025. It's not permanent. It's going to go through 2029 and then revert back to the old limit, the $10,000 limit, starting in 2030. So this is something that Congress later will need to pass to extend, or it will revert back to this smaller limit, to the $10,000 limit that we had before. So how does it impact your planning right now? And it does need to impact your planning right now because it's effective this year, 2025, even though we're already halfway through the year. If you have been capped out in your itemized deductions on Schedule A from this $10,000 SALT tax limit, you've got to take a look and say, well, now that this limit has been expanded to $40,000, will this mean you'll itemize? Will it mean if you add up and you project out your state and local taxes that you pay, your property taxes, does it mean you're going to itemize this year? And if so, that could mean that you've got a larger deduction than what you expected, and maybe you should explore strategies like Roth conversions or inviting some income into this tax year because, again, this new SALT limit starts this year but is not permanent. Maybe you want to bring some income into this year while you've got this higher deduction. But then the second way, or another way this could impact your planning this year, is if now this means you're going to itemize, what else should you optimize since you're going to itemize this year to expand and increase and optimize your itemized deductions? Should you do some advanced giving strategies this year because you're going to itemize? And again, this SALT tax limit increase is not permanent, capturing more charitable deductions or other deductions while you're going to itemize so that you get the biggest benefit from it. You've got to work on those individual applications with your certified financial planner based on these new and unique rules. Work with your certified financial planner on that. If you don't have a CFP on your team, you can contact one on my team. Find us online, Korhorn.com, that's Korhorn with K, wisemoneyshow.com, you can find us there as well, or give us a call, 574-247-5898. All right, there you have it. Go out and take your next wise step in your financial life.